The clock is ticking on one of the most explosive opportunities in precious metals history. And if you're not paying attention right now, you're about to miss something that only happens once every few decades. Silver is approaching $50 an ounce. But here's what most people don't understand. This isn't just another price rally. This is the beginning of a structural shift that's been building for years. And the countdown has already started. Let me show you exactly what's happening behind the scenes, because the forces driving silver right now are unlike anything we've seen in modern markets. First, let's talk about the supply deficit. Silver has been in a supply deficit for multiple consecutive years. That means the world is consuming more silver than it's producing. And this gap is widening. Industrial demand hit record highs recently. We're talking about over 1.3 billion ounces of total demand. That's an 8% increase year over year. And it's not slowing down. Why? Because silver is absolutely critical to the technologies that are reshaping our world. Solar panels, electric vehicles, 5G infrastructure, semiconductors, medical devices. Every single one of these industries is consuming silver at unprecedented rates. Here's a number that should wake you up. Each electric vehicle requires between 25 and 50 grams of silver. Some estimates go even higher for certain models. Now multiply that by the millions of EVs being produced globally. That's just one sector. Solar panels are even more dramatic. The solar industry alone is projected to consume over 150 million ounces annually. And as countries race to meet climate goals and energy independence targets, that number is climbing fast. But here's where it gets really interesting. While demand is exploding, supply is struggling. Silver mining is incredibly complex. Most silver doesn't come from primary silver mines. About 70% comes as a byproduct of mining other metals like copper, lead, and zinc. So when those base metal operations slow down or become unprofitable, silver supply gets squeezed. And that's exactly what's happening in multiple regions around the world right now. Production costs have been rising. Energy costs, labor costs, equipment costs, environmental compliance costs. All of it adds up. Many mining operations are barely profitable at current prices. Some aren't profitable at all. And here's the kicker. You can't just flip a switch and produce more silver. Bringing a new mine online takes years, sometimes a decade or more, from exploration to permitting to construction to actual production. It's a massive undertaking requiring billions in capital investment. So we have this perfect storm. Surging demand from industries that are only going to grow, constrained supply that can't respond quickly, and a deficit that's been building year after year. Now let's talk about what's happening in the financial markets, because this is where things get absolutely fascinating. Central banks around the world have been accumulating precious metals at levels we haven't seen in decades. They're diversifying away from dollar-denominated assets. They're buying gold by the hundreds of tons. And silver is coming along for the ride. The BRICS nations have been particularly aggressive. They're building alternative financial systems, alternative payment rails, alternative reserve assets, and precious metals are at the center of that strategy. Think about what that means. When major economies start shifting their reserve holdings, when they start questioning the dominance of the dollar, precious metals become exponentially more valuable, not just as commodities, but as monetary assets. We're watching the early stages of a massive monetary shift, and most people have no idea it's happening. Let me give you some historical context, because silver has done this before, and when it moves violently. Go back to the late 70s. Silver was trading around $5 an ounce. Then something remarkable happened. The Hunt brothers started accumulating. Industrial demand was strong. Inflation was raging. And silver went absolutely parabolic. By early 1980, silver hit $50 an ounce. That's a 10 times move in just a few years. People who positioned themselves early made generational wealth. People who waited missed the entire move. Now, I'm not saying we're going to see an exact repeat. Markets never repeat exactly. But the underlying dynamics are eerily similar. Supply constraints, monetary uncertainty, inflation concerns, industrial demand. All the ingredients are there. Fast forward to 2011. Silver was trading around $18 at the start of the year. Then the financial crisis aftermath kicked into high gear. Quantitative easing, currency debasement, fear in the markets. Silver rocketed to $49 by April. Another massive move in a compressed time frame. And again, the people who understood what was happening made extraordinary returns. Here's what both of those periods had in common. They weren't just about speculation. They were driven by fundamental forces, real supply and demand imbalances, real monetary concerns, real industrial needs. And that's exactly what we're seeing now. Except this time, the fundamentals are even stronger. The supply deficit is larger, the industrial applications are more critical, the monetary system is under more stress, and the geopolitical tensions are more severe. Let's talk about the paper market for a moment, because this is where things get really interesting, and a little bit controversial. The silver market operates on two levels. There's the physical market where actual metal changes hands, and there's the paper market where contracts and derivatives trade on exchanges like the COMEX. The paper market is massive, hundreds of times larger than the physical market, and that creates some interesting dynamics. When you trade silver futures or options, you're not actually buying silver. You're buying a contract that represents silver. Most of these contracts never result in physical delivery. They're settled in cash. This system works fine when everything is calm. But when physical demand surges and supply tightens, things can get messy. Because suddenly, people want actual metal, not paper promises. We've seen glimpses of this stress already. Premiums on physical silver coins and bars have spiked at various times. Delivery delays have occurred. Spreads between paper and physical prices have widened. Now imagine what happens if this stress intensifies. If more investors demand physical delivery, if industrial users get worried about securing supply, if the paper market's leverage becomes unsustainable, you could see a situation where the paper price and the physical price diverge significantly, where the true value of silver in your hand becomes much higher than what the exchange says it's worth. This isn't conspiracy theory, this is basic market mechanics. When you have a highly leveraged paper market sitting on top of a tight physical market, something eventually has to give. And when it does, the price discovery mechanism shifts from paper to physical. And that's when you see explosive moves. Now let me address something important. If you're sitting on significant retirement savings, you need to understand how precious metals can fit into your wealth protection strategy. A lot of people don't realize you can hold physical gold and silver inside retirement accounts. Gold IRAs allow you to get actual metal into your IRA or 401k without triggering taxes or penalties. I put together a free guide that explains exactly how this works. It's in the description if you want to check it out, especially relevant if you've got six figures or more in retirement accounts and you're concerned about dollar devaluation. All right, back to where this price is headed. The technical picture on silver is incredibly bullish right now. We're seeing patterns that typically precede major breakouts. Strong support levels, rising moving averages, increasing volume on up days. The $50 level is significant psychologically. It's a round number, it's where silver peaked in the past. It's a level that gets attention. But here's what most analysts miss. $50 isn't the target. It's a way station. When silver breaks through 50 convincingly, there's very little resistance above that level until you get into the 60s and 70s. Think about it. Silver hasn't traded above 50 in over a decade. There are no recent sellers up there. No one who bought at 55 or 60 waiting to get out. The path of least resistance is up. And if we adjust those historical highs for inflation, silver should be trading well above $100 just to match its previous peak in real terms. That's how undervalued it is relative to its own history. But let's bring this back to the fundamentals, because that's what really matters. The green energy transition is accelerating. Every major economy has committed to massive infrastructure spending on renewable energy. Solar installations are projected to grow exponentially over the next decade. Electric vehicle adoption is happening faster than most forecasts predicted. Major automakers are going all in on EV production. Some are phasing out internal combustion engines entirely. 5G networks are being built out globally. The amount of silver required for the infrastructure is staggering, and we're still in the early innings of that build-out. All of this requires silver. Lots of it. And there's no substitute that works as well. Silver has unique properties. Best electrical conductivity of any metal. Best thermal conductivity. Highly reflective. Antimicrobial. You can't just swap it out for something cheaper. So industrial demand is locked in. It's not discretionary. It's not going away. It's growing. Meanwhile, investment demand is starting to wake up. Silver ETFs have seen inflows. Coin sales have been strong. Retail investors are paying attention again. But institutional money hasn't really arrived yet. When pension funds, endowments, and sovereign wealth funds start allocating to silver, that's when things get really interesting, because they move billions at a time. And they're starting to look. They're seeing the same fundamentals we're discussing. They're seeing the supply deficit. They're seeing the industrial demand. They're seeing the monetary uncertainty. It's only a matter of time before that capital starts flowing in. And when it does, the relatively small silver market is going to move fast. Let me give you a sense of scale. The entire above-ground silver market is worth maybe $50 billion. That's nothing in the world of institutional capital. Apple has more cash on hand than the entire silver market is worth. When even a small percentage of institutional money decides to allocate to silver, it overwhelms the available supply. Prices have to rise to clear the market. We're also seeing interesting developments in the mining sector. Silver mining stocks have been beaten down for years. Many are trading at valuations that make no sense given the current silver price. When silver starts moving, these stocks typically leverage that move. A 10% move in silver can translate to a 30 or 40% move in a well-positioned mining stock. That's the leverage of operating margins expanding. Smart money is starting to accumulate positions in quality silver miners. They're looking at companies with low production costs, strong balance sheets, and growth potential. They're positioning ahead of the move. Now let's talk about the geopolitical dimension, because this is crucial to understanding where we're headed. The world is fragmenting. The post-World War II order is breaking down. Alliances are shifting. Trade patterns are changing. And the dollar's role as the global reserve currency is being questioned. Countries are looking for alternatives. They're settling trade in local currencies. They're building payment systems that bypass the dollar. They're accumulating hard assets. This isn't happening overnight. It's a gradual process, but it's accelerating, and precious metals are benefiting. When trust in fiat currencies erodes, people turn to tangible assets, things that can't be printed, things that have held value for thousands of years. Gold and silver fit that bill perfectly. We're also seeing supply chain nationalism. Countries want to secure critical materials domestically. They don't want to be dependent on potentially hostile nations for the resources they need. Silver is a critical material. It's essential for defense applications, for technology, for infrastructure. Countries are starting to think about strategic reserves. If governments start stockpiling silver the way they stockpile oil or rare earth elements, that removes supply from the market permanently, and it puts upward pressure on prices. There's also the inflation factor. Real inflation, not the manipulated government statistics. Anyone who buys groceries or pays rent knows prices are rising much faster than official numbers suggest. Precious metals have historically been a hedge against currency debasement. When the purchasing power of paper money declines, hard assets maintain their value. Silver is one of the most accessible ways for regular people to protect themselves, and unlike gold, silver is still affordable for average investors. You can buy an ounce of silver for around $30. That's accessible. That's something people can accumulate over time. This accessibility is important, because when the general public starts buying, when regular people start protecting their savings with physical metal, that's when you see sustained bull markets. We're starting to see signs of that awakening. Social media discussions about silver are increasing. YouTube videos are getting more views. Coin dealers are reporting stronger sales. The narrative is shifting. People are starting to understand that the financial system is more fragile than they thought, that their savings might not be as safe as they assumed, that they need alternatives. Silver offers that alternative. It's real. It's tangible. It's been money for 5,000 years. And it's still undervalued relative to almost any metric you want to use. Let's look at the gold to silver ratio. Historically, this ratio has averaged around 15-1, meaning 15 ounces of silver equal 1 ounce of gold. Sometimes it's been as low as 10-1. Right now, the ratio is much higher. Even with silver's recent strength, you need significantly more ounces of silver to buy an ounce of gold than historical averages would suggest. This means one of two things has to happen. Either gold needs to fall significantly, or silver needs to rise significantly. Given everything we've discussed about silver's fundamentals, which scenario seems more likely? When this ratio reverts to historical norms, and it always does eventually, silver is going to move dramatically. We're talking about potential gains that dwarf what gold might deliver. That's why sophisticated investors often overweight silver relative to gold. They understand the leverage. They understand the mean reversion potential. They understand the industrial demand story that gold doesn't have. Now I want to address the skeptics, because there are always people who say precious metals are outdated, that they don't generate cash flow, that they're just shiny rocks. Here's the reality. Silver is not an investment in the traditional sense. It's insurance. It's a store of value. It's a hedge against systemic risk. You don't buy silver hoping it goes up. You buy silver hoping you never need it. But if the financial system experiences serious stress, if currencies lose significant value, if supply chains break down, you'll be very glad you have it. And right now, with everything we're seeing in the world, that insurance is looking more valuable every day. The banking system is under stress. We saw bank failures recently. We saw deposit insurance limits tested. We saw the government step in with emergency measures. The bond market is flashing warning signs. Yield curves have inverted. Credit spreads are widening. Default rates are rising. The real estate market is showing cracks. Commercial real estate is in trouble. Residential prices are stretched. Mortgage rates are elevated. The stock market is concentrated in a handful of mega-cap tech stocks. Breadth is weak. Valuations are extreme. Sentiment is complacent. All of this creates an environment where hard assets become more attractive, where diversification away from financial assets makes sense, where having something real, something tangible, provides peace of mind. Silver checks all those boxes, and it has the added benefit of explosive upside potential if the supply-demand dynamics play out the way they appear to be heading. Let me paint a picture of what could happen over the next few years. This isn't a prediction. It's a scenario based on current trends continuing. Silver breaks through $50 convincingly. Maybe it happens this year, maybe next, but it happens. And when it does, it triggers a wave of momentum buying. Technical traders see the breakout. They pile in. Algorithms start buying. Retail investors get excited. Media coverage increases. The price pushes to 60, then 70. Industrial users start getting nervous about securing supply. They begin forward buying. That adds more demand. Investment funds start allocating. They can't ignore the move anymore. Billions flow into silver ETFs. That creates more physical demand. Mining stocks explode higher. A quality silver miner trading at $5 goes to 15, then 25. Early investors make multiples on their capital. Physical premiums spike. Coin dealers can't keep inventory. Delivery times extend. The spread between paper and physical widens. At some point, maybe silver is trading at $80 or $90, maybe higher. And people who bought at 30 or 40 have doubled or tripled their money. But more importantly, they've protected their wealth. They've diversified away from a financial system that's showing serious stress. They've taken control of part of their financial future. That's the opportunity we're looking at right now. That's why the countdown has begun. Now, I'm not saying you should put your entire net worth into silver. That would be reckless. Diversification matters. Balance matters. But having some exposure makes sense. Having a position that benefits if these trends continue makes sense. Having insurance against monetary chaos makes sense. The question is, what's the right allocation for you? That depends on your situation, your risk tolerance, your time horizon, your other assets. But I'll tell you this, the people who look back 5 years from now and wish they'd bought silver at $30 are going to be the same people who are hesitating right now. The opportunity is here. The fundamentals are clear. The technical setup is bullish. The macro environment is supportive. The countdown to $50 has begun. And what happens after 50 could be even more dramatic. This is one of those moments where the pieces are all in place, where the smart money is positioning, where the trends are aligned. You can wait for more confirmation. You can wait for the price to break out. You can wait for everyone else to figure it out. But by then, you'll be buying at much higher prices. You'll have missed the early part of the move. You'll be chasing instead of leading. Or you can act now, while silver is still relatively cheap, while the story is still under the radar, while you can accumulate at prices that will look like a gift in hindsight. The choice is yours, but the clock is ticking, and time is running out to position yourself ahead of what could be one of the most explosive moves in precious metals history. The countdown has begun. The question is, will you be ready when silver reaches 50? And more importantly, will you be positioned for what comes after?